Hello, and welcome to today's financial literacy course, Budgeting in the Digital Era, sponsored by Arbor Financial Credit Union. My name's Ben, and I'll be your facilitator today. Today, we're going to go over tips and tricks to be successful in budgeting in the digital era, primarily from a mobile device. Before we jump into that, let's consider the following. How well do you currently budget? Consider financial goals you might have set. How did they end up? What were the reasons you were not successful at reaching this goal? Would you consider yourself better or worse at budgeting than your peers? When you think about your personal group, are you more successful or less successful at financing or even maintaining a budget? When was the last time you tried to stick to a budget? And lastly, what would be the last straw that would happen to you that would make you ask for help? Let's first define what budgeting actually is. Budgeting lies at the foundation of every financial plan. It doesn't matter if you're living paycheck to paycheck or earning a six-figure income. You need to know where your money is going if you want to have a handle on your finances. Unlike what you might believe, budgeting isn't all about restricting what you spend money on and cutting out all the fun in your life. Budgeting is really about understanding how much money you have, where it goes, and setting financial goals to allocate those funds appropriately. It also means, to me, giving every dollar a job. All right, pop quiz. How many people in the U.S. have a budget? 68%. So of those 68%, how many people do you think stick to their budget? 33%. So there's a significant decrease from the amount of people that actually create the budget that can actually stick to it. Why might that be? Do you have any money goals that you've set for yourself that you were not successful in hitting or achieving? Have you ever thought about what set you back? Here is a cool tip sheet that I use a lot when I explain budgeting to people. It's called the 50-30-20 method. It's simple and it goes like this. 20% goes towards your financial future, paying down debt and building up your savings. Yes, you must do both at the same time. Generally, you might have debt because you were not so good at savings in the first place. It doesn't mean necessarily that it's 10-10 down the middle as far as which money goes where. It depends on a lot of other things, but roughly 20% of your income should go here. And this is your net income. The 30% goes towards your wants. Takeout dinners, I know I love those. Concert tickets, going to drinks with friends, maybe furniture for your house or apartment, or even fun tech gadgets. You can enjoy the finer things in life as long as you created a goal and stuck to it and achieved it. It might not take you as long as you thought, and that's okay, but it should never be something that's just bought on a whim. Make a goal and plan for it. Finally, the 50% goes to your essential needs, honestly. You got housing, transportation, insurance, grocery, healthcare, utility bills. You might think of maintenance on your car. It falls in that transportation category. Your groceries. Do you have animals? Do you have kids? This can be very expensive. Also, healthcare. And then also your housing is one of the most expensive costs that most people take on. It's the biggest investment that generally most people buy in their lifetime. The other thing that you need to understand about budget is the difference between wants and needs. This is where I've seen a lot of people make mistakes, and it's cost them largely. I remember my third year in banking, a lady walked in, and she was at the end of her wits. She wanted to save money, and she could not. She lives paycheck to paycheck. She's a single mother. Upon going over her finances over the last few months, I think we did a 90-day look back, we found that she spent over $580 at Starbucks. Now, how could one possibly miss this? I can tell you, just in my experience, it's very common. $5 here, $6 there, and then over a period of time it adds up. And it doesn't always set in until you take that period of time and add it all together and realize it's a large number. So with this lady, to make it fair, again, it's not about restricting all the fun. It's just about understanding where your money came from and where it's going, giving every dollar a job. We set her to a budget. And over the next couple months after that meeting, she was able to save up $400 or $500. So this is a lady that says that she could not save a single penny, and just by going through her finances, her statements, we were able to find extra money and free it up. Now, that doesn't always mean that if you free up money, someone's going to save it. You might just better the quality of your life or pay down debt. It could be temporarily put in different places. But again, what it comes back to is definitely understanding the difference between a needs and a want. You might really like coffee, but you can't afford to go to Starbucks every day or twice a day. It adds up. Now that we understand what budgeting is and kind of how to maintain a budget, let's look at how people do banking in the now times. Transfers and transactions happen in real time. I could literally be in line at the grocery store, forgotten to have moved money from my savings account to my checking account, pull up my mobile device, make that transfer, and instantly have access to those funds before the lady's even done scanning my groceries. We also have very little to no check activity. Most of us get paid digitally. Now, even days when my parents give me gifts, it's electronic gift card. But if you do get a check, you can actually use the technology called mobile deposits or also mobile capture. This is where you take a picture of the front and the back of the check and it gets deposited in your account. And then you get to save about 15 minutes on average instead of going to your bank or a finance institution. My favorite, which is the most important thing I recommend to everybody, if there's anything you take away from this presentation, I recommend this, is text alerts. It's a free service your finance institution provides. It keeps you proactively in reach with your account at all times. If you're driving down the road and all of a sudden someone hacked your account and made an Amazon purchase, you'd get a text alert right away. A lot of finance institutions, from that alert, you can even stop that transaction or put a hold on your debit card. If you don't have text alerts, you might not know this activity is going on, and you could take up to 30 days until you find out. If you're a real traditional bank where you wait for your statements to come in when you clear your check register. Now, a lot of times I can talk all types of people into text alerts simply by just saying it's an enhancement to your account. It doesn't matter how you do your banking now. It can definitely just enhance the security on your account or also just your wits about it. I get my balance texted to me every single morning. But the major four, because I know sometimes people have tried them out and they've gotten too many and it becomes an annoyance. But I recommend the four. There's the major four. It's the online, over the phone, outside the United States, and at gas stations. So most would say that's where primarily a lot of compromised numbers come from, just due to the locations and areas of where those places are at. And also rules and regulations, especially when you get outside the United States with the online over the phone orders. So text alerts, again, very important. Keep you right there on spot. The next one is electronic bill pay and e-pay. I love this one a lot because a lot of the times the bank guarantees the delivery date. If you can select it, we guarantee it and we'll back it up if we can. I also like it because if a company were ever to call me up that I've paid through my bill pay and say they were missing a payment from some odd months back, I don't have to finger through multiple pages of my check register. I can just click on that bill's name and it'll give me all the transactions. Even upon further research, I can get routing and transit numbers to provide to that company so they can see where that money was, essentially has gone. And then the last one is ID alert or Social Security protection or your Social Security number protection or anything along those lines. It's much like having car insurance, but it protects the Social Security number. I think most people have a misconception that their bank would cover that naturally. Now, don't get me wrong, the bank protects everything that you house with them. So your bank account numbers, your personal information that you provided them, and those types of things, but they don't protect your Social Security number by itself. Now, your financial institution surely will offer something along this line. Generally, it's about the cost of a cup of coffee. A lot of them provide a monetary coverage. Most I know is between $10,000 and $15,000, which is so conveniently the average cost that it takes on to a person when their information is compromised to recover, through court fines and costs. But it also allows you to see your credit report, and there's a lot of other services like news, other tips to help build your credit. So really, for the small dollar amount you're paying, again, about the cost of a cup of coffee, you really are getting a great benefit. If you don't have that, I recommend stopping your financial institution, make it an opportunity to introduce yourself to your banker. I always find it better to know the person that's dealing with your finances before you're in peril or you're upset or you're under some type of duress. Nothing worse than when you're in that position, that meeting someone brand new and having to trust someone that you've never talked to before. So if you don't have some kind of identity protection, definitely swing in, see if it's something your financial institution offers, the cost, talk about it, introduce yourself, create a relationship with your banker today, because it'll make everything in the future a lot easier. This is my favorite part of the presentation, when we go over a multi-account usage. Now, to some, this might be foreign, and to others, this might be something you're already doing, but I'm going to do my best to explain how I've seen people be successful with it. So each one of these boxes represents a separate checking account. Now, don't look at it as a checking account with a check register and all the statements. Just think of it more of like a jacket with a zipper pocket. You got some on the inside, some on the outside. You can move money around either to keep it safe or to make sure you don't overspend. So our first account is going to be our direct deposit hold account. This is where, you guessed it, your direct deposit's going to go. So we get direct deposit, and then usually the first thing we do once we get paid is we're going to pay our bills. We move exactly the amount that we need to move to our bills account. Maybe we split up our bills over 2 paychecks. Whatever way you do it, you still pay all your bills out of this account. This does 2 things. First off, it keeps your bills separate from other expenses so that you don't accidentally overspend, which is a common way a lot of young people get into overdrafts, or even older people as well. And the other thing is, at the end of the month, if all your bills are paid, what do you think happens to that account? It's going to fall to 0. So instead of spending time going through a check register and checking off each check that's cleared with the statement you've gotten 2 weeks after the month's already closed, that day, if the account is zeroed out, you already know all your bills have been paid. After we pay our bills, we're going to give ourselves an allowance. Now, you can call this account whatever you will, but it's the account that's going to have your debit card linked to it. This is where you're going to make your everyday purchases. This is where you're going to put your free money, or the money you can spend guilt-free that's not reserved for something else, or that you're saving it for something else. This account does a lot of things. I love the fact that it keeps your money separate from your bills, also your direct deposits coming in, and also your savings, so there's a layer of separation for security. This also allows you to give yourself a budget. I give myself $100 a week. Even though I get paid bi-weekly, every Friday I get $100, and it's nice because it creates kind of like a repetitive motion of how my money flows in and out of my account. If I were to drop my debit card, the best part is the most that someone could get their hands on. So if I drop my debit card, let's say at a restaurant or a grocery store, and someone gets it, the most that they're going to get their hands on is essentially $100. Now, I have made larger purchases through this account, but I'll generally do an instant transfer to this checking account, make the purchase. So again, there's not generally too much money sitting in that account, more than $100. And then after I give myself my balance or my allowance, I have money to put in my savings. As we talked earlier, anywhere between 10 and 20% is a good amount to save. Now, this is a very common setup that a lot of people have for accounts. You can nickname your accounts. I will advise you that your financial institution can see the names of these accounts, so be wise on what you name them. However, you might find yourself adding more accounts. Here's some examples that I do. I have a vacation fund. So as I told you earlier, I get paid bi-weekly, and $50 from one of those paychecks goes into my vacation fund. After 12 months, that's $600. So I set that account to be 12 months mature in June, so that in the middle of the summer, I have $600 saved up that I relatively didn't notice was going out of my paycheck. Now, $600 might not pay for everything, but it sure is nice to have something to offset it. And then I do the same thing with my holiday fund. Generally, for most, around November and December, there's holiday gatherings, spendings, travel. Things can be more expensive, or that you're spending more than you normally do versus the other months. Well, my other paycheck gets $50 dumped to that one. And so by December, which I set it to be the month of maturity, I have another $600. And again, this doesn't necessarily pay for everything, but in months of heavy spending, it does allow to make your life a little bit easier and a little less stressful. And then finally, like a lot of people, I like to sell things on Facebook Marketplace. I might sell stuff on Craigslist, other locations like that. And I have accounts set up for that when I get paid, I get either from PayPal direct deposits, or let's say I got cash and deposit in my account, that it goes to this account so that I don't lose or commingle funds with other things I have going on. So if at the end of the day, if I want to see how I'm doing with my buying and selling, or let's say something happened to one of the checks I received from a person selling it, it's not going to return on my main account and affect other things. It's a separate account. Now again, most of these accounts, except for the savings and the reserve account, are just checking accounts. They just have no debit card, except for my free money account. But they allow you to have your money on your phone. When you pull up your accounts, you see all these accounts. You can see how they move. You generally learn kind of maxes and minimums these accounts should have. You learn your paydays. So there's a lot of great things about having a spread out account structure when you don't sit down with a check register and have one account that you're doing everything through and doing that budget. This is how a lot of people have been successful in budgeting in the digital era. And to review what we just went over, we want to nickname all accounts. This will allow us to see that when we do open up our mobile banking, all of our accounts in row, kind of what their job and purpose is, to see if everything's going the way it should. We also want to keep in mind that our financial institution can see these nicknames, so we want to choose wisely. Also, create disposable income account. This was the free money account. This is of the checking accounts, the one that has the debit card. Again, we can make larger purchases through this account, but it's just we would log in, transfer the money to that account, and instantly use it. This is where you would give yourself your budget, so you can try to stick to it. With budget, I always recommend starting low and then realizing how much you spend. The best part about that is it makes you aware, or at least top of mind, of how much money you're spending. Let's say, for example, you started off with $50 for the week and you blew through it within the first 2 days. Now you're going to remember you have to log in on Wednesday morning to transfer yet more money. So start with the lower amount, find out where your actually spending level is at. You might be surprised, or maybe not. Maybe you're really on top of it. For me, it was a surprise. So this is where I liked it the most, having that separate account. And then again, have a separate account for bills, just so that your things are not messed with. You don't accidentally overspend. I see a lot of people having issues with auto bill pays, where it might fall on a certain date. Like, let's say, for example, it's the 1st, and here comes the 2nd, and you don't see that money actually leave your account. So you call up that company. They say yes, they have received the money, but it still has not cleared your account. So you think maybe just randomly you have extra money, which is generally never the case. And then the next day it'll pull out, even though you might have accidentally spent that money. So this is why I like the bills account. So you don't have to worry about how it pulls, when it pulls, especially if you're utilizing the ePay function through most financial institutions. The guaranteed date puts a little bit more comfort in that as well. And then utilizing automatic transfers. As I told you, I had the travel and the holiday account where $50 from each one of my month's paychecks went to that account, and I had $600 each month offset. Then we want to review our free money account. Understand that what you take home and pay out in bills are very constant. We're not generally getting raises, and we're generally not paying off our debt overnight. After 60 days, review your free money account with a needs and wants analysis. Simply put, get 2-color highlighters, go through your statement, and define in your mind's eyes what are wants and needs. Are you like our Starbucks lady? Or do you have your stuff under control already? Set some goals for yourself as well. Having a budget is key, but on top of having a budget, you should always have different financial goals. These goals could be expenses that you're going to be taking on in the near future, or something fun. Try using SMART goals to free up the cash flows. And then lastly, make money work for you for a change. On the last slide, I talked about SMART goals. I'd like to spend a moment just to define what that is. So a SMART goal is simple like this. S for specific, very clear, and not vague. My example that I like to use is, I want to save $100 by the end of this month. Is it measurable? Something you can see or touch? Yeah, I could show you my bank account at the end of the month, and you can see that I had that $100 in there. Is it achievable? This is my favorite step because it does allow us to consider the small steps or potentially project what kind of roadblocks might run into. Sometimes this is also an eye-opener for people that have goals. Maybe your goal's a little advantageous and there's smaller goals that you have to achieve before you could even possibly hit this big goal. So I like that one a lot. Is it realistic? Is this even possible? I've seen some people attempt to save out of the blue from saving nothing, 25% of their income, and they don't realize the impact that has on their quality of life, and it's very difficult. I'd recommend professionally to start small, 5-10%, move it up a couple percent each month and make it gradual so it kind of goes, below the radar the best as possible, but it's not such a shock to you. And then, is it timely? If you have money that you have sitting in an account that you don't really have a goal for, that's when we're not having money work for us. And that's something we want to do, is we want to give every dollar a job. There are a lot of options that we have, and if you don't know, talk to your local banker or financial representative, because there's a way that if you have idle money, regardless of what you intend to use it for down the road, you can earn more off it than just sitting in a savings account. So have a goal for it, and this might help you free up extra money and actually earn extra income off of money that was otherwise making next to nothing. But at the end of the day, being honest and holding yourself accountable is key here. I do really like when people involve someone else besides a significant other in this, because if you set a goal for yourself and you don't tell anybody, the only person you're letting down if you don't tell anybody is yourself. Well, if you tell somebody, there might be accountability that's created. And I've seen a lot of people be successful by having that honest friend that they talk to each other about it. They know how much money each other makes. They know where their finances are at because they're telling somebody. And it's very healthy to talk about your finances. People that are not good with their money, they're generally very quiet about it. And same people with people who have a lot of money, and it's not saying boast or flaunt what you have, but talk to people about it, because it does make it easier to understand where you're at. Also keeps you accountable. That's the key. So in wrapping up here, I got one last thing to show you. What does it take to blow $10,000 in a year? Just $27.40 a day in miscellaneous spending. So that $5 coffee, that $10 fast food to go order, it does add up over time. Just keep that on top of mind. And finally, I want to thank you on behalf of Arbor Financial Credit Union for your time today. It's been a pleasure. I really hope these tips and tricks help you out in your everyday life. If you have any questions or concerns or comments, please feel free to reach out to me at bharman@arborfcu.org. That's BHARMAN @arborfcu.org.